Hey option traders, this is Jeff. I wanted to quickly go over the two naked put positions that I currently have open and show you how I think about rolling them out to the next month, if I'm going to roll them out to the next month. I'm only going to do that if the stock is hanging around the money. If the stock runs away, say like in the case of Coke here, if it was like at $70 or $75 a share, it wouldn't be worth rolling. So I would just wait for another month, or just let it expire worthless, or sell it for when it gets down to less than a nickel, or whatever. But since it's so close to being in the money, or at the money, I'm going to roll this, and this will actually take a quick jump over to the chart here. 1, 2, 3. I've already done 3 rolls on this, and I'll explain this in a minute. And I'm about to thinking about doing my 4th roll. All right, so how do I do this? Well, I'm going to turn on the drawing tools here, and it'll freeze the data, but we can live with that. Current price is approximately 68, and our open strike is at 67.50. It's like perfect. It can't get much better than this. And what I look at, starting about a week or a week and a half or so before expiration, is I input a theta column here and my extrinsic column, and those are the two things that I look at the most. So for the extrinsic, which is the time value of this particular option, even though it's now Tuesday and expiration is Friday, there's actually 32 cents of extrinsic value left in this. The theta is 6 cents, so theoretically, at a minus 6 cents, it's going to lose 6 cents a day. But that accelerates as you get closer to expiration. So if you were to take 32 and divide it by 6, you would come up with about 5 something or another, almost 6 for an answer. So it's saying like maybe 6 days, but we only have 4 days to expiration. It's going to accelerate. And that's it for the current month. Now we look down here, and I've already done a theoretical roll, and it's telling me that it would give me a $1.12 credit. I have it locked. I locked it before I started making this video. And that is a pretty nice credit for a roll. But it's going to get better, and I'm sure it can get up to $1.20 or $1.25, provided the price of the stock stays around where it's at. And let's go take a look at that right quick. Here is the 67.50 strike price, and you can see that since I opened this back in August, the first one that I did was the day before August expiration. I did a September 67.50, and I really pulled in kind of a nice credit there of $1.21, which made my cost basis $66.29. Then a couple days before expiration, because the price was so high up here and it looked like it might be going higher and it might be running away from me, I decided to roll again, and it was nice enough to give me a $1.40 credit and brought my cost basis down to $64.89. Then actually on the day of expiration, which is right here, and you can see the price of the stock was right around 68, hanging around there that day. Rolled it again for a $1.25 credit, and a cost basis now of $63.84. So even if I should fall asleep on expiration day, and the stock goes below, if it hangs around here on expiration day, and I could put the stock, it still will only have cost me $63.64, and then I can start collecting these 47-cent dividends. So you can see how the naked put is outperforming the dividends. It's not going to happen all the time. This just happens to be a prime, perfect, freaking example, and it's been working really, really well. All right, the other one that I have, and I wrote this one up too, I have a post on it, is Yahoo. And, you know, there's been rumors of several suitors for Yahoo, which prompted me to buy a long call. And I'm going to freeze this right now too. To buy a long call. And you can see that down here. And I did a couple of naked puts too. Now, this is the first month that I will be rolling this. And let's look at the extrinsic is on my current open position is 7.5 cents. And it's losing 3 cents a day. And it's almost worthless right now. Price is at 15.78. Our strike's at 15. So that's looking pretty good for a roll. But again, I'm going to wait because let's look at next month. At the 15 for next month, we have an extrinsic of 67.75, and it is only losing a penny a day. So it looks like as though we could get up to, provided that everything stays exactly the way it is now, we could end up going up to as much as a credit of 65 instead of this 58 that we have here. Now, what do we think is going to happen based on a little bit of technical analysis? We'll take a look at the chart. And here's the 15 strike that I bought on 1024, and you can see that the cost basis is, well, I mean the credit that I got for it was 41 cents, and the cost basis is 14.59 right now. Where the stock is going, I don't know. I have this alert set up here, and that's for the purposes of letting me know if the stock goes to 17 and I'm asleep on this one. It's going to alert me and tell me that you want to take a look at your call, and you may want to excuse me, cash in on that call, and also cash in on the naked put and make some nice money on this. And we can take a quick look at that. I've already gone over pretty much the logic for when to roll. I'm not going to roll any of these. I watch them every day. Just take a peek at them and see how they're doing. Just take a look at the risk profile, and we'll take the short ones, the naked put out, and you can see that my alert at 17 is telling me that right now that long call that I have would be worth 32, but if it should move up, I'm anticipating 19 because I've heard that as a rumor as a value for a buyout, or 20, somewhere between 19 and 20, and make anywhere from like $150 to $230 on that, while still collecting the credit on the naked put, which is kind of cool. So I think that that's it for right now. I may attach what I do on Thursday or Friday of this week to this to show you just how easy it is to do this. Pretty much on autopilot, because you can see that, well, at least in the case of Coke, and let's take a look at that, because Coke actually went kind of deep in the money. Here you can see that, and I just like, okay, whatever it's going to do, it's going to do, right? Because I didn't mind having a naked put on this because owning the stock was okay with me. But it pulled back, and it came back up, and it's been hanging around this 67.50 strike and just pouring in the money, sort of. I mean, hey, net on risk in this case is pretty low. So I've been pretty happy with this particular trade, and hopefully for Yahoo I can end up paying for that long call that I have, and then have that long call pay off I believe that is a December or a January long call, I believe. Yes, it is actually April of 2012, as noted here. So that long call is can still hang in there for a while. That's it on rolling naked puts, the week of expiration, first look. Let's see what happens later on in the week.